Hey guys, it's Hakeem here, and today I present to you a tech stock that I believe is vastly undervalued after having fallen over 50% from its all-time highs. So in this video, we're going to run through the financials of the company before moving on to my valuation, which will illustrate to you why I believe this company is massively undervalued in this overvalued market. But look, I'm not going to hold you ransom until the end of the video for you to find out what that stock is and exactly how undervalued it is. I'll be upfront with that. So this stock is Pinterest, and I believe it is at least 40% undervalued at the current price. Now, for those of you that are unaware, Pinterest is an image sharing and social media service designed to enable saving and discovery of information, or specifically ideas, on the internet using images. Now, historically, people have often considered Pinterest to be a bit of a social media network, but now people are realizing that actually it's not a social media network, it's actually a type of search engine. And actually it's one of the largest search engines in the world with over 450 million monthly active users. Now, of course, that's not even close to the billions of monthly active users that are using the two largest search engines, being Google and YouTube. But then again, you're not paying $2 trillion for this stock. Actually, you're getting this stock for under $30 billion at today's prices. Now, in terms of Pinterest's business model, well, it's really quite simple, which is great. Effectively, they generate their revenues through advertisements when users are visiting their platform for inspiration for a particular thing. For example, maybe a new kitchen, a home renovation, or a new outfit. They will look at the pictures, and if they see something that they like, they will be directed to the website of the owner of that thing. Once the foundations are laid for the business, they can increase their revenues very easily without having to increase their costs in tandem with that. And effectively that leads to margin expansion and then significant amounts of profits. So with all of that in mind, let's jump across to the computer and get into the detail of this stock. Now, the first thing that I want to say about this is if you've been a holder of Pinterest over the last year, you have not had a very good time. So we can see here that the stock was at $90 back in February 2021. You fast forward to today, about 9 months later, and we are down to $43. So that's a decline of over 50%. And now I think that this creates a fantastic buying opportunity. Now, admittedly, this is a stock that has benefited from COVID, and that makes a lot of sense, right? Because more people were at home looking for things to distract themselves with, such as home renovations, for example, and effectively more people were using the app. And that makes a lot of sense. The great thing is, though, is that given that lockdowns have now effectively been removed, people are still visiting the apps in, by and large, the same quantities, right? So effectively, the business hasn't died off, which is great news. Now, there has been a slight decline in their US monthly active users, but we'll get on to why that, for me, isn't such an issue at this time. But just before we jump into the earnings report, I do want to address one thing, and that is the way in which Pinterest is often compared to Facebook, for example, as well as Alphabet, being effectively Google and YouTube. And the reason for that is because all of those generate their revenues through advertisements. But I think that there is a distinct difference that many people are actually missing. And the key distinction between these platforms for me that I think a lot of people are missing is that when people go on to, for example, Facebook and YouTube in particular, they aren't necessarily looking to buy a product. Effectively, they are faced with advertisements that they didn't particularly want to see. In contrast, we've got Pinterest, where effectively the user, as in the people that are using the Pinterest app, are actually going onto the app with the intention of being inspired and therefore buying something new. And I think that that in many ways is a better platform for the advertiser, because you know that there is an increased chance that actually somebody clicking onto your website will likely or more likely lead to a purchase, as opposed to somebody that was never looking for that particular item anyway. Now, that's not to say that I think that Facebook and Google's advertising businesses aren't great. Anybody that's watched any of my other videos knows that I think that those businesses are fantastic, but I think it is something worth pointing out, in particular when we come to the average revenue per user for Pinterest, and we'll compare that with Facebook, which goes to show me the potential of Pinterest. Anyway, so the first thing that I want to get into for Pinterest is the revenue growth for this business, which is absolutely phenomenal. So these percentages along the top are the year-on-year revenue growth percentages. 58%, 76%, 78%, 125%, 43% in the most recent quarter. Now, bear in mind that was Q3 2021, and you're comparing that to Q3 2020, when presumably more people were at home due to lockdowns. Now in Q3 2021, safe to say that most or the majority of lockdowns no longer are going on, and yet they still managed to grow their revenues by 43%. So for people that were saying that this is a COVID-only business, don't really understand the business model. A couple of other important things to note here is that the US makes up the majority of their revenues, so $500 million from the US here in Q3 2021, and only $135 million from the international users. Now that's important, because so bear that in mind. However, international growth was 96% year over year, compared with US growth of 33% year over year. And this is very promising for me because the majority of their users are actually international. So if they're able to grow their revenues for their international user base, they will be able to expand their revenues for the company by and large a lot more than just focusing on their US base. We then move on to their monthly active users. And I think that this is what was concerning for a lot of investors. And this is why we've seen Pinterest dip slightly after their earnings. And that is because as we look at their US users, we can see that they have actually been steadily declining. And I think that they've effectively plateaued now at around 90 million users. In my opinion, the most likely users of Pinterest are going to be people between the ages of 18 and 50. I think that anyone below 18 isn't particularly interested, right? This is not a social media network. And I think that people over 50 just aren't going to be interested in using the app. So I think that your sort of age range, your total addressable market is between the ages of 18 and 50 by and large. When we look here, right, we can see that 65% of Americans are aged between 15 and 64. I therefore think it's probably reasonable to assume that around 55% of people, or maybe 50% of people in the US are going to be between the ages of 18 and 50. Okay, so why is that important? Well, if we scroll down here, we can see that the total population of the United States is approximately 320 million people. Let's be conservative and say that 50% of those are between 18 and 50. That means that there is a total addressable market of 160 million people. Now, if Pinterest are already at 90 million users per month, I don't think that it's realistic that that user base is going to grow. So within my considerations for the business, I can't forecast in that their US user base is going to grow. And that detail right there, that Pinterest have effectively reached their capacity for their US user base, is what I believe has scared off a lot of investors, but I don't consider it to be an issue. And that's because the way that Pinterest are going to grow their revenues is through increasing their average revenue per user. So we can see here that over the last year, Pinterest were able to grow their average revenue per user by 44%, up to $5.55, which is fantastic growth, right? But I don't think that they are anywhere close to their maximum amount of average revenue per user that they can realistically achieve. And the reason I say that, when we flick across to Facebook, we're looking at, for the US, average revenue per user of $52. Of course, there are some nuances in here, right? So first of all, more people will visit Facebook on a daily basis, which will result in increased revenues, of course. So there is that. And I'm also certainly not expecting that Pinterest will ever reach $52 average revenue per user on a quarterly basis. But I certainly think that they can get closer to $10, $15, or even $20. And here is why. Effectively, when people are visiting Pinterest, they are going there with the intention, as I said earlier, to actually buy something. They are going there to be inspired. When people are going onto Facebook, they aren't necessarily doing that with the intention of buying anything. And I think that that is quite a good bargaining power of Pinterest in order to increase their average revenue per user by effectively demanding relatively high prices to advertise on their business. The greatest amount of potential, however, is not even within their US user base. It's actually within their international user base. So we can see here that they actually grew their average revenue per user on the international users by 81%. But when you actually look at the figures, they are so minimal. And effectively, management have already come out and said that they haven't even begun to try and completely optimize the monetization of these users, because there are some nuances in terms of dealing with these international users, and that is going to take some time to play out correctly. But clearly they are working on it. An 81% growth in their average revenue per user for their international user base is fantastic. And the reason why that is so important is because their international users make up about 3/4 of their total user base. So if they can increase their average revenue per user of those users by a greater amount, we'll see a significant growth in their revenues. Now, of course, there's no point in us focusing solely on revenues if the company is not ever going to generate a profit. Luckily, that is not a concern for Pinterest because they already generated a profit in the most recent quarter. So on $632 million of revenues, they generated a net income of $94 million. That's compared with a net loss of $94 million a year earlier. So the growth in this business is fantastic, and they are only now beginning to really optimize their margins in order for profits. Now, speaking of profits, we can see here the slide for adjusted EBITDA, and we can see the EBITDA margins in gray. And we've seen EBITDA margins as high as 42% over the last year. However, we have also seen it as low as 17%. With the the latest quarter at 32%. Now, considering that this is a very high margin business with gross margins as high as 80%, I think that the EBITDA margin of between 30 and 35% is very realistic for this type of business. Now, you do always have to be careful when you're considering adjusted EBITDA, because management can use this as a way of effectively removing any costs which they consider to be one-off in nature, even though sometimes that might be a little bit debatable. And therefore, if a company is saying that they are achieving adjusted EBITDA margins of 35%, their EBITDA margins, their actual EBITDA margins could be significantly lower than that. But that is not the case for Pinterest. So we can see here the latest quarter, right, September 30, 2021, they had net income of $94 million. So they add back depreciation and amortization, add back interest, and add back taxes. So that's completely normal, and that is how you would arrive at EBITDA. Now, we do have share-based compensation here of $96 million. Now, that is quite a large add back, but it's actually no more significant than we see for comparable companies, particularly in this sort of early stage in their life cycle. And then other than that, there aren't any sort of strange adjustments in here. So you can see that we've got termination of future lease contract, but these values are nil in the latest quarter. So that $201 million of adjusted EBITDA for the final quarter is a good representation, and that margin is a good representation, which, by the way, the margin was 32%, is actually a good reflection, a good representation of what the company is actually able to achieve going forward. And the reason I mention that is because I'll be using that figure within my valuation later on. And then the final bit that we want to look at is their balance sheet, just to see whether there's any possibility that they might need to raise cash, either through debt or share issues later down the line. So we can see here that they've got around $2.3 billion in cash, and they've got basically no debt. They have some operating lease liabilities. Some people classify that as debt, some people don't. For me personally, I do. So in my view, they've got $189 million of debt compared with $2.3 billion of cash. Not only that, they are cash flow positive. So as far as I'm concerned, there is no concerns in the short to medium term that this is a company that's going to need to raise cash. So then that brings me on to my valuation. Now, I use a discounted cash flow and earnings multiple model as part of my fair value valuation. And then I also use an enterprise value to EBITDA multiple to try and come up with a price target for around 5 years from now. So we can see that the current market capitalization is just under $28 billion. And I'm projecting for revenue growth of 25% for years 2 through to 5. And we look on a historical basis, we can see revenue growth of 60%, 51%, 48%, and 51%. And then analysts, so this is this column here, analysts are projecting for 29% in 2022. And then I'm expecting 25% growth year over year for the next 4 years. And then for years 6 to 10, I have projected for 18% revenue growth. So I think that that revenue growth will decline, but I still think that they are going to put in solid numbers over the next 10 years, simply because I think that the business model is so great. I've kept gross margins consistent at 80%, and I think that that is a fair representation of what they can achieve going forward. And then for operating expenses, I've actually decreased these over time as I expect the business to optimize their margins. So what I was saying earlier on, that actually once the foundations are laid, you can generate greater revenues without your cost base actually increasing too much. And that's what I'm expecting for Pinterest. So I expect that this will level out at around 50% of revenues in terms of their operating expenses by around 2025. So according to each of those inputs, my model suggests that Pinterest will be generating revenues of around $18.5 billion for 2031, compared with $2.5 billion this year, and net income of $4.5 billion compared with $223 million for 2021. So of course, that's a significant jump in each of those numbers, but this is a 10-year horizon for a very fast-growing company. Now, in terms of my discounted cash flow model, so we can see that for 2021, EBITDA margin is 12%, and I'm expecting next year that to be 15%, then 20%, 25%, and effectively I'm expecting by 2026 for it to hit 32% and for us to then plateau. So this is not an adjusted EBITDA, it's an actual EBITDA margin. And I think that they can achieve 32% by 2026. And in reality, I think that that is very conservative. I think that they will achieve 32% much before 2026. But anyway, I like to remain prudent. In terms of our unlevered free cash flow as a percentage of EBITDA, I've gone with 80%. Now, if we look at the year most recent, we're actually looking at 106% of unlevered free cash flow as a percentage of EBITDA. But I like to be conservative, and therefore I've gone with 80% in my estimations going forward. That provides us with an intrinsic fair value according to the model, according to the discounted cash flow, of $59 a share. And according to a multiple of earnings based on a P ratio in 10 years time of 22.5 of $61. Now that gives us a fair value per share of $60, which suggests a margin of safety of 41%. Now, one of the challenges that I may get here is based on the PE ratio being 22.5 in 10 years time. But in actuality, I actually don't think that that is super bullish. I think that that is probably fair, considering that my model suggests that this is going to be a very high margin business. Anyway, if you wanted to be super conservative, go with something closer to, for example, 18, we might be suggesting an intrinsic value closer to $49. And if you look at the average of the two, you're looking at $54, which would still be a margin of safety of 26%. So that is what I think that the company is worth today. But what about if we fast forward to 2026 and apply a enterprise value to EBITDA multiple to our expected EBITDA at that time? So according to the outputs of my model, we're looking at a 2026 EBITDA of just under $2.6 billion. I've then applied a 22.5 enterprise value to EBITDA multiple to that figure. We get a 2026 enterprise value of $58 billion. Even after I take into consideration that their shares outstanding are going to increase due to the outstanding share options that they currently have in place, that gives us a 2026 price target of $87, which would be a compounded annual growth rate of 17.5%, which is not too shabby at all. So in my opinion, this is your archetypal example of a GARP stock. So GARP stands for growth at a reasonable price. And I think that the price that you're paying for the amount of growth that you can achieve in this stock is very attractive at this valuation. Anyway, guys, I hope you've enjoyed the video, and until next time, thank you.